Welcome back to our YouTube channel, it's Sahara Equity. This is Jazz and I'm here today continuing with my last session of how to evaluate a deal. The last time we talked about location. So when you find something, find a property, and we are going to focus mostly on multifamily, just like I mentioned the last time. So when you find a property, a multifamily property that you want to buy, acquire, you feel that this is something you want to start off in, the first thing you're looking at is a location. Correct? So let's do a quick recap here. I have the same students with me here who attended the last session about the location. So I want to have you guys, recall on what you guys learned from me the last time. So what exactly do you want to look in a location? Proximity to the closest highways, to all the other facilities, to schools. Correct? Okay. What else?
Employment opportunities.
Employment growth, employment opportunities, correct?
Crime rate.
Crime rate. So crime rate on what side? The higher side or lower side?
Lower.
Of course. You don't want to live in a higher side or buy something in a higher crime rate area, correct? Median household income, correct? And the location?
Population growth.
Correct. So you would want to see where it is. The household income is something that you would want to, you will not have any issues collecting the rents. So you would want to evaluate the household income. And then the last thing you want to see is the population growth in that location. All right. So we talked about the location. We're looking at the property details here. The details in the property that you would want to consider is the condition of the property, as in what shape is it in? Does it require any kind of further improvements, any deferred maintenance items, such as the unit's interiors itself? Are they up to par, up to market in your immediate submarket? The age of the property, and we'll talk a little bit more about the age of the property by classifying into A, B, and C in one of our other sessions. And then what kind of revenue is this property currently making? Do you have room to improve its revenue, or is it already at the peak of where the market rents are and other income that's collecting? The expenses, are the expenses on par? Is it too high? Can we cut down the expenses, or do we need, or is it really running at a lean expense ratio that we cannot really cut down anything? And then occupancy rate. So where does it currently stand? If you are buying a 4-unit property, are all 4 units occupied? 100-unit property, are all 100 units occupied, or only 80 units are occupied and 20 units are vacant? So that makes your occupancy as 80% for 100-unit property. Unit mix, whether it's all 1-bedroom units, 2-bedroom units, 3-bedroom floor plans, what kind of floor plans it is, because that's really important for you to analyze what kind of property, what kind of rents you'll be collecting, and what will be your unit turnover, how often your unit will be turning over. So usually if it's a 1-bedroom units, you expect the turnover to be high, just because it's not a family in 1 bedroom. Usually it's not a family in 1 bedroom. It's not families with children, so they tend to move faster, whereas 2 bedrooms and 3 bedrooms, you will expect to have families in there who want to stay in longer term with kids around them. Submarket, so you would want to explore furthermore on the submarket, on the employment growth, job growth, where this overall submarket is heading, so you can account for all of those in your underwriting. So we've got all of these, and we just add the rental comps as well. That tells us where the current market rents for this property is, if you have room to improve more rents, or it's already at the peak of the submarket rents. Now, where would you be able to get all of this information from? This you can get from a marketing package, which is also called as OM, or offering memorandum. And this is put together by the broker who has listed this property. If it's an off-market deal, that's a different story. But if it is a listed property by a broker, you can always get this offering memorandum, which is a marketing package, and get all of these details in, or I wouldn't call it really details, but more of a summary in the offering memorandum. And then you have to do your own due diligence further, and we'll talk about the due diligence in the next session, in one of the future sessions. Offering memorandum will give you all of the summary of all of this. Now, where you really need to spend more time is analyzing the income and expenses. To get more details on the income and expenses, that's where you will request the operating statement, also called as P&L, from the broker, who would in turn get it from the seller who is currently managing. So you would want to understand the current revenue and the expenses by looking at the P&L, which will give you details about what kind of income you're collecting other than rental income. What other income are you collecting? A lot of late fees? Are you collecting any kind of court fees? So that kind of tells you the tenant base that you have in that property. Or the late fee is always zero. There is no court fees. Then it's more upscale, more A-class. And then on the income side, on the expense side, what kind of expenses do you have? Where does your payroll stand? Where does your administrative expenses stand? How much are your taxes? How much is the insurance? How are the utility costs? All of those details will be in the P&L. So we'll go over an actual P&L report to give you more details on how to evaluate the expenses and income. Let's take a break here and continue on to our next video, where we want to actually walk you through an operating statement and break down the actual revenue line items and expense line items, and help you understand how we look at a P&L to do a back of a napkin analysis.